According to Open Secrets, the financial industry spent over $2.4 billion lobbying the US government in 2024. The reason is that every dollar they spend shaping the rules can unlock billions more in profit. Now, private equity, which is a corner of Wall Street most people never deal with directly, just got the green light to tap into 401ks. If you don't understand how this game works, you could end up working into your late 70s because they're quietly siphoning more from your retirement than you realize. So let's break down what this change is, what it means for your money, and how to protect yourself before it's too late. Thanks to a recent regulatory shift, private equity and other alternative investments can now be included in 401k plans. Up until now, these types of investments have been off limits for retirement accounts like 401ks for a lot of good reasons that we'll get into in just a bit. Alternative investments can mean a lot of things, but the ones that concern me the most are annuities, private credit, hedge funds, and the star of this dumpster fire, which we'll be focusing on in this video, private equity. Most plans are going to continue to stick to the basics like index funds, bonds, target date funds, and the equally terrible high-fee actively managed funds. But now the door is open, and with over $10 trillion in 401k money up for grabs, it's only a matter of time until this industry finds its way into your plan. If private equity captures just 1% of that, that's $100 billion flowing into their funds. At a standard 2% annual fee, that's $2 billion a year in pure profits. No wonder they spent $21 million last year and $11 million this year lobbying the government. I know these amounts are large, but let's stop to appreciate how little it actually is in the grand scheme of things. It really doesn't take that much money to pay off politicians, which is pretty gross. Think about it, if they're willing to drop that kind of cash just for permission to access 401k plans, they'll surely spend millions more to weasel their way into as many 401k offerings as possible. And that's why this is worth paying attention to. This isn't a technical change buried in some fine print of boring retirement policy. It's a green light for the financial industry to start figuring out how to sell this stuff to people like you and me. To be fair, the change won't happen overnight since it takes a lot of time to get the paperwork and administrative side of things figured out. But fast forward 5 or 10 years and you'll start seeing more 401k plans littered with this garbage. To understand the major problem here, you first need to understand what private equity is and how it works. At its core, private equity is just investing in companies that aren't publicly traded, meaning you cannot buy or sell their stock on an exchange like you can with Apple or Microsoft. Instead, private equity firms raise giant pools of money from institutional investors, pensions, endowments, and ultra-wealthy families. They use that cash to buy companies outright, take them private, quote-unquote improve them on paper, and eventually sell them off for a profit. At least that's the sales pitch they'll give you. In reality, they can still make a fortune even if the company fails because they profit from extraction, not just success. They're basically playing both sides of the court, and no matter what the outcome is, they win the whole game. That means layoffs, wage cuts, selling off valuable assets, and loading companies with mountains of debt they never planned to repay. While the business struggles to breathe and is literally choking on its own failure, the PE firm collects management fees, pulls out dividends, and drains cash through interest payments. When they're done, they're either going to flip it, they're going to take it public, or they're going to let it collapse completely because they win either way. Here's what that looks like in the real world. Familiar brands were gutted, downsized, and stripped for parts. In healthcare, it gets even darker. Studies have linked private equity-owned hospitals and nursing homes to higher patient mortality rates. Sometimes the cost of quote-unquote efficiency is literally human lives. But hey, who cares if we lose a few lives here and there if we're making some money in the process, am I right? We'll call it the cost of doing business. Pay off a few politicians, maybe pay a few fines, and everyone will look the other way. They love to present themselves as corporate saviors, but the reality says otherwise. Tens of thousands of jobs lost, stores closed, and brands absolutely destroyed. Through all of it, the firms still make billions because the goal was never to save these businesses. It was to strip them like an old car in a junkyard. And now they want access to your 401k so they can run the exact same playbook with your retirement savings. Except there's more to this story. Destructive behavior like this can only run so long before the machine starts breaking down. For decades, private equity had an endless supply of money from places like pensions, insurance companies, and elite university endowments. They'd buy companies, strip the value, sell them, return some cash to investors, and pocket huge fees in the process. But now, that model is hitting a wall, and they don't want you to know about it. Right now, PE firms are sitting on a record $3 trillion in unsold companies because buyers just aren't there. For context, this is double what it was in 2019. That's like trying to run a car dealership with a parking lot full of cars that no one wants to buy. Their business model is pretty easy to understand, but it only works if they keep flipping companies. It goes like this: buy a company, cut costs and load it with debt, sell it to a buyer, then use the proceeds to raise the next fund. But when $3 trillion worth of companies are stuck with no buyers, the whole model breaks. If they can't sell, they can't return cash to investors. And if they cannot return much cash, they have a hard time convincing investors to give them even more money to feed into this model. What's making it even worse is that high interest rates have made buyouts more expensive. IPO markets have dried up, and corporate buyers are walking away. Reuters described the current mess as buyout giants choking on assets they cannot unload. If there were ever a time I didn't feel bad about watching someone choke on something, it would be right here. Even their most loyal clients, the so-called smart money, the ones who are supposed to know better, aren't too happy with them. Yale's University Endowment paid close to $1 billion in fees last year for a measly 5.7% return. In case you missed it, the S&P 500 returned at 25% in the same period. Harvard has 40% of its $50 billion portfolio in alternative assets like private equity, but so much of it is locked up, they've been selling at a discount just to raise cash. According to the Financial Times, investors have responded by resisting new fund commitments. Private equity fundraising dropped 23% in 2024, with the industry drawing in $401 billion in new assets, the weakest tally since 2020. When the Ivy League's best and brightest are bailing out of your investments for a loss and not giving you more money, you've probably got a liquidity problem. Then comes the recent executive order opening the gates to America's $10 trillion 401k savings. To private equity, this is an opportunity, and it's what I like to call a rescue package, or dare I say a bailout for this $3 trillion liquidity mess they've created. As you just saw, private equity is facing a squeeze from every single direction. They need cash to pay back existing investors. They need new investments to keep the fee machine running. And they need it quickly before their $3 trillion backlog gets worse. Opening the door to your 401k gives them something they desperately need: a fresh source of capital that doesn't demand quick liquidity because it is your 401k and you're saving for retirement, which usually has a 10, 20, or 30-year holding period, doesn't ask too many questions, and keeps paying fees even in down years. Now, to be a little more candid and I guess direct here, this whole thing looks and feels like they're getting bailed out by gaining access to over $10 trillion worth of 401k funds. Sort of like how we taxpayers had to bail out banks back in 2008 because they were knowingly selling risky financial products that eventually blew up in their face and the whole country's face. Pretty interesting how only one person went to jail for playing a part in causing the 2008 financial crisis. Really, only one person destroyed the whole US financial system and by default, the world's financial system? Please, tell me more. This whole private equity and 401ks sounds like privatizing profits and socializing losses. Because, of course, nowadays, that's the American way, right? Okay, we've covered why private equity wants into your 401k, but as I showed you earlier, they do make money, so you might be thinking, hey, maybe I want to put a little bit of money into private equity if it becomes available in my 401k. So now, let's talk about why you should avoid these funds if they ever show up, whether that's next year or 10 years from now. With something like an index fund, you can sell your shares at any time. With private equity, forget it. Your money is locked up for 5 to 10 years. That means if you lose your job, face a medical emergency, or just want to rebalance your portfolio, then too bad, so sad. That long lockup period is part of why they love 401k money so much. You cannot touch it, so they get years of guaranteed fee collection. The standard model is 2 and 20. A 2% annual management fee plus 20% of the company's profits. Compare that to 0.02% to 0.10% for a good index fund that's most likely going to perform better, especially after fees. Morningstar found that over time, these fees can consume 50 to 60% of your total gains. And remember, they get paid whether you make money or not. And keep in mind, Yale got ripped off for $1.2 billion in fees last year for 5% returns when the S&P 500 returned 25%. Private equity loves to claim market-beating returns, but they often value their own holdings themselves. That means they can smooth or boost the numbers to look less volatile and more profitable than reality. When you finally cash out years later, that smooth ride can turn into a pothole. A Johns Hopkins study found that after adjusting for risk, most PE funds don't outperform simple index funds. We've seen what happens when private equity takes over companies: layoffs, debt, and bankruptcy. In your 401k, that doesn't just hit one company. It can lock away a chunk of your retirement in a failing strategy you cannot exit. And yes, you could end up in one of these funds by accident, especially if they're hidden in a way that I'm going to show you in just a minute. Here's the thing most people don't realize. Some strategies work well when capital is limited, but flood them with cash and the best opportunities disappear fast. The easiest way to understand this is imagine a small fishing lake. By yourself, you can catch a big, giant fish every single day. Now, add 1,000 more fishermen or fisher women, fisher people, then pretty soon there aren't any big fish for you to catch. If billions in 401k money floods into private equity, firms will be forced to buy lower quality companies or take riskier bets just to put all of that money to work, which drags down returns for everyone except the managers still collecting fees. We've already seen how they cannot offload the $3 trillion worth of companies they have right now. Imagine if these irresponsible lunatics gained access to even more money through your 401k. The executive order may be signed, but there's still a long road of approvals, product design, and plan provider decisions before anything hits your 401k. But here's the thing, when it does arrive, it won't come with a flashing neon sign that says, "Hey, private equity fund over here, invest in us," or "Don't invest in us." If anything, they will blur the language so you do not notice. At the very least, we can predict how they might appear in your retirement plan. So here are some of my best guess examples to watch out for. Standalone alternative investment funds are the most obvious path, and they'll be labeled something like Alternative Opportunities Fund, Private Market Growth Fund, or Diversified Private Capital, which all translate to we're going to diversify your money into our pockets. Expect vague language in the fund description like access to exclusive private market opportunities or enhanced diversification. You know, real BS phrases like that give off very highbrow investing styles. It'll sound smart and harmless until you read the fine print and see the 5 to 10 year lockup period. This is the sneaky one that would really bother me if it happened. Target date funds are the default investment for millions of Americans, and many people never change them, and private equity knows that. A fund manager could quietly shove 2 to 10% of a target date fund portfolio into private equity without you realizing it. You'd still see the familiar Target Retirement 2070 fund label and think nothing has changed, but under the hood, part of your retirement just got tied up in high-fee, illiquid garbage. I'm telling you right now, if this happens and I find out, I am going absolute scorched earth on every single target date fund in sight. Next are what I like to call Trojan horse funds. They might be marked as balanced or multi-strategy funds and look like 70% in regular stocks and bonds, 30% in private equity or private credit. On the surface, they look like regular high-fee actively managed funds, but read the holdings section or the statement of additional information and you'll spot the private market slice. Insurance-style wrappers would be where private equity teams up with insurance companies to sneak into guaranteed income products in your 401k. It means now you're paying private equity fees plus insurance product fees. It's like getting mugged twice on the same walk home. Since an annuity falls under the quote-unquote alternative asset classification, these are something you're going to see pop up in 401ks that you need to watch out for. If you want me to cover the topic of annuities within a 401k, then let me know in the comments down below. Even though you can usually switch 401k funds daily, private equity doesn't play that game. The first way this will happen is some funds might only let you take money out once a quarter if they actually feel like it. The second way is others will use what's called gates, which is financial speak for we will give you your money when we are good and ready. If too many people try to pull out at once, withdrawals are usually delayed or capped in this example. The third way this will happen is in blended funds, the public part might be liquid, but the private equity slice will be glued to your portfolio like gum on the bottom of your shoes. And if you want to do one thing to avoid this whole mess entirely, buy index funds and nothing else, and you'll be good to go. Now, private equity isn't the only threat hiding in your 401k. There are other traps baked into the retirement system that are just as dangerous, maybe even worse in some cases. If you want to see what they are and how to avoid them, check out this video to your left next. That is where I break down the rest of the ways the system is designed to fail you, and more importantly, how you fight back. Hit that like button before you go. I'll see you in the next one, friends. Done.